Good morning, everyone. We are here with Kevin Green for a special report. We bring these up on weekends. I called this an emergency the other day, and people were very upset. And to me, I feel like if Kevin and I are awake on a Sunday morning and trying to film a video for you guys, it's an emergency. But for real, this is going to be fun. Always excited. Like when Kevin hits me up and says, "Hey, we should do a video," I'm like, hell yeah, let's try to make it happen. It's earlier for Kevin. Kevin is in Colorado. I'm in Ohio. I'm on East Coast time. So Kevin got up real early today. So, I thank Kevin very much for coming on today and just doing this because there's so much going on in the markets and so much that we should be talking about right now that I feel like a lot of people are just missing. And so Kevin's the guy to kind of tell us what he's seeing, what we're looking for, and what we could have going forward. So how are you today, Kevin? What are you seeing in the markets and how have you been?
I'm doing good, Jason. Man, I always appreciate you having me on. Yeah, you and I will have these texts, and then sometimes they just don't work, right? Because we're both busy guys, and then sometimes it's like, let's do it. It's I always like coming back on this show because one, you know what you're talking about, and two, you've been there from the start, man. And I always do appreciate your color and commentary when it comes to the markets. Everything was good, man. I've been off since like Wednesday. Thanksgiving was great. My boys, the Kansas City Chiefs, pulled it off. That was great. Saw those Bears actually win. That was interesting. So, everything is actually pretty decent, man. Like the market itself, if we kind of want to just jump into it, so I want to be able to make sure we kind of hit some of these areas here. The market itself, I find it very funny that like usually when we're down in the dumps and we have a VIX of 25, 26, 27, and then the Bulls, they're nowhere to be found. And then honestly, the Bears don't even speak up anymore because they know it's always going to be short-lived. I mean, the market usually goes up, right? 80%, 82% of the time, the market is actually moving to the upside or advancing. And there's only a small portion of the time where we do see a pullback or maybe a retest of a support level. So in this type of market, or in this type of game that you and I are in, you see a lot of favorability to the Bulls because obviously there's positive inflows traditionally within the markets. And that's just how, money multiplies itself and things of that nature here. So if we kind of go back to last week and what we actually did see, actually it was probably the week before on Wednesday, we saw the VIX get to around 25, 26, 27 or so. And I wrote a piece, you guys all can see it, but basically it was kind of like, hey, keep calm, right? Like here's some things to know about volatility. The VIX itself is it's a mean reverting index, and it's also an exponentially accelerant type of index as well, which means when things do happen, it re-rates aggressively higher. And then when we do actually have that news item that sits in the market for a very long time, what do we do as traders and investors? We digest that information and we start seeing that volatility index starting to come down, even though there still might be perceived risk in the market. And that's exactly what we saw. Once you get to around this 2 standard deviation move for the VIX compared to its mean, which right now it's around 18 and a quarter or so, if you look at the last year, and that also includes that 65 VIX pump that we saw, right? And so, like, once we kind of get to those extreme levels, some things that you really want to look at is really the VIX complex itself or the VIX options. Once you really start seeing a lot of traders, especially institutional traders, trading in big lots, if you will, starting to sell call credit spreads to the VIX, that's usually when you start seeing the market actually gyrate or move here. And then also we have the S&P 500 weekly chart up. I'm a big fan of weekly charts. You are as well. One thing to know about the S&P 500, once it gets to that 20-week moving average, which is in blue, also somewhat equivalent to the 100-day moving average, usually the first test of that in a cycle is not when we truly fail, right? It's usually the first test of that is usually when we see a follow-through week. And that's exactly what we saw last week, was a follow-through week. And in fact, traditionally, we will see another follow-through week. May not be as aggressive. Traditionally, it's not as aggressive as what we saw last week. But we usually don't hit that 20-week moving average and then flush. So you had the VIX at an elevated level. You had a test of a key moving average here. We had some buyers really trying to step in. And the weekly, I will tell you, the weekly, if you look at that MACD, you look at the RSI, we are not out of the woods yet. And I think right now everybody's trying to give that all clear signal. And I would just say be cautiously optimistic when it comes to this market. This is not a recommendation, but if you are looking at this weekly chart, the RSI is still making lower highs at this point in time, right? It's still technically in a downtrend. That MACD is still crossing, right? And so does that mean that this is going to be gloom and doom? No, but it just means, respect the technicals on the longer term time frame. I know everybody's looking at the daily right now. We broke structure to the upside, which is great, but understand as well, usually these breakdowns that we have in the market isn't a 1 week or 2 week event. It's something that actually does take a little bit of time here. And we also had we had a shortened week because of the holiday. And then two, if we can go to that next slide, I think this is very key, and everybody has access to this, right? If you're in TOS, you can look at other trading platforms as well. This is the S&P 500 total composite volume. So we take the S&P 500, the total, 498 companies or whatever in the S&P 500, and you add up all of their volume. This is what the chart's looking like. So we had this breakdown when it came to tech. Tech is a huge weighting in the S&P 500. But when you saw under the hood here, especially when we had that kind of capitulation reversal, that hit of the 100-day moving average or that 20-week moving average, you actually started seeing composite volume going up. And what did we also see? Market breadth actually expanding very aggressively. And that's something now, obviously, we start seeing it fall off here a tad bit. Got to keep in mind, obviously, shortened trading day on Friday. We also had the leading up to Thanksgiving as well. But what you did see is this rotation and this broadening out. Now, there's two reasons why that's going to take place. One, it's a rebalance for a lot of institutions getting ready to prepare for the remainder for next year, right? Looking at opportunities in the market. And then also you have the situation where a lot of institutions, they're behind their benchmark. Say their benchmark is the S&P 500, and let's say the S&P 500 is up 15%. A lot of those institutions that are actively managed are below those levels, right? It's really hard for an institution to outpace the S&P 500 for a couple of reasons. One, S&P 500 does not rebalance like we normally would in an institutional account, in a balanced type of an account, right? Where we have these risk parameters, where an NVIDIA gets a little bit outstretched, you may have to sell that, or Meta gets a little bit outstretched, you have to sell that and rotate other places. S&P 500 does not do that, right? It's a passive index. So you also have institutions that are probably targeting smaller industries, smaller sectors for alpha for the remainder of the year, because it's a lot easier to move a smaller sector in the S&P 500 for outsized gains, right? Or for alpha, if you put enough dollars to work, than it is going into the technology sector, which I would still argue that there's still probably some structural concerns that are within the technology space. So I think that was actually the best setup that you could have for a bull. You had the move to the downside. You had pretty much us getting to that 2 standard deviation move for the VIX. And then you also had this end of the year sector rotation. And now you are starting to see value really starting to outperform. Even you're looking at the S&P 500 equal weight. It's really doing pretty great here. So that's kind of where I'm at when it comes to the indexes. I think that we probably have another follow through week, maybe, right? Just technically speaking. You may have another follow-through week next week, but I would say we're not out of the woods yet. If you're looking at the Fed and everybody's kind of talking about, well, the market's moving up because of this rate cut narrative. Okay, let's actually look at that real quick. The rate cutting narrative went from only 30% chance of a cut in December for 25 basis point rate cut. Now we're sitting at around 86, 87%, right? Because of comments from one voting member that has been on the fence, but now looks like well-defined to be a 25 basis point vote here in December. But what's also going to happen, Jason? What you're going to also see a lot, if we're this much on the fence about December, what does that say about January, guys? And that's where I think that you may have one of these hawkish cuts that take place, where we do get the cut, but the commentary probably is not going to be all that great, because even the members that are on the fence around 25 basis points, they're basically saying 25 basis points, then hold, not 25 basis points and let's continue to party, at least for now. And so I think that's going to be probably your biggest risk that we're going to have when we have this Fed meeting coming up. I believe it's on the 10th, if I'm not mistaken. So keep your eye out on that. But what do you think about the overall market in general?
Yeah, I think I agree with you. I mean, there's a couple things about it. One is this is the thing that's interesting in what you said about value and technology. We're looking at value and growth. Really, growth is a lot of technology stocks. Value, like we're talking about financials, energy, and so on. Healthcare's in there. There's a bunch of stuff in there. Anyways, they're very mixed up indexes, but they're almost polar opposites. And what I think is interesting to think about going forward is the fact that if we get this move in technology, like let's say everybody keeps talking about the S&P 500, they're like, okay, well, obviously the S&P 500 is a lot more than 7 stocks. Like it could go up if those start to go down. And I think the scenario could be like it's a no. Like even people forget as recent as 2022, like energy was up that year, I think up like 50%. And value, I think the value index was, I don't know if it was up, but I know it was down slightly or just slightly up that year. And the S&P 500 was down 20%. Bonds were down around 20% as well. So if we look at that and the weighting of the S&P 500 at the moment, with technologies such so big and these big tech names basically running the S&P 500, do we think there's a scenario where the S&P 500 can go up without the big tech names moving up with it?
Yeah, so it makes it harder because of the math, right? And I think that's kind of what you're talking about.
Yep.
Mathematically speaking, it is very tough, especially like now we basically say tech. And when we mean tech, a lot of people say tech and they also include communication services into that, right? You're also including, because Google Alphabet is is a communication services company sector, right? It's in that sector. And then you have Meta, which, you know, you can argue Meta's still a tech company, but it's not in that tech basket. So could you move without those two? It is possible. It just makes it harder. But in that same type of environment, does it make it harder for the broad-based index? Yes, but you probably do find a lot of alpha in the other sectors as well that people just don't talk about on a day-by-day basis, right? I talk on the network all the time, and the majority of the conversations that we have are around technology, right? Because that's what people want to trade in, that's what people watch. But if you look at maybe some of these other sectors that are actually catching a bid, some of them actually have been underloved. And you could make a case that they probably have a little bit more of a secular trend going into 2026. And so, does it make it harder? It does. I would rather see a market that's broadening out and we stair step higher in a healthy manner than us being concentrated and us, moving higher aggressively, but it's on the back of one or two companies. That's just how I look at it. Some people say, no, like, as long as the index goes up, I don't care how it goes there. But you have these situations where we just experienced it. I mean, people are going to forget this already. It just happened darn near a week and a half ago, where you had the broad-based index. You're looking at the volume right there. That you actually had a lot of dollars being put to work, but the index itself is being dragged down by one or two companies, right? Because of a concern around TPUs and GPUs and this whole battle that's taking place that I think is probably getting a little bit overblown here. If you're looking at the long-term time frame here, now if we're going to kind of talk about next year, and I won't sit on this for too long. What was this year? This year was the year of announcements. That's
Mhm.
what I'm calling it, right? It was the
That's
year
true.
of announcements.
Yep.
You had a lot of enthusiasm, and NVIDIA did a deal with OpenAI, or NVIDIA did a deal with XYZ company, or Google's doing a deal with this company, or Oracle doing a deal with OpenAI and completely over leveraging themselves, which right now, like, once again, a little bit of an issue if you're looking at the broad-based index. But next year is the year of spending. And I think if you kind of look at the opportunities, it may not be so much in tech. People love tech. Tech has been commanding the S&P 500 for the last, 15 years, 20 years or so. But if these dollars are going to be put to work, at least the initial dollars are going to be put to work, where is there going to be opportunity? That's where you start saying, okay, well, they got to excavate, right? They got to build out these data centers. They got to move dirt. They got to lay piping and build out these small modular nuclear reactors, which are building out some now. They got to build out the infrastructure when it comes to natural gas piping and energy generation itself. A lot of those dollars that we've been hearing about now have to be put into action. And I think the big concern that the market has had is all that money real? Is it all going to happen? I don't know. I'm a little skeptical of it, only because if you look at the energy equivalent of what's being announced, I find it very hard to believe that we're going to be able to build out that much infrastructure on the energy front. But that's just me, right? Like, if we look at it, I'll do the calculation real quick. And these numbers are going to be a little bit dated. I think it's actually a little bit more here. But if you're looking at OpenAI, I believe that they've already announced 31 gigawatts worth of power, right? When it comes to their infrastructure alone. That's including the Oracle deal and all of this other stuff, right? So every gigawatt, 750,000 homes. That's the equivalent of it, right? So if we take 31 gigawatts and multiply that by 750,000 homes, you're talking about 23,250,000 home, single family home equivalent, which is, I believe, like 30% of the overall homes that are available in the United States that are being occupied right now. That's a very tall order if we actually put scale to that. But if you're questioning that, is that spend going to happen or not? they at least have to build, right? They at least have to show the effort. It may not get to the finish line, but you can at least get to the 15, 20%, 30% there. And so I think that that's where the plays are when it comes to industrials, which have been doing a good job, but there's probably a lot more opportunity within the industrial space alone. Utilities, I think traditional utilities have been, they've been doing all right, but everybody's been looking at these SMR companies, small modular reactor companies here. But I think if you look at the traditional ones, they're the ones that are actually putting the capacity back into the grid. The Duke Energies of the world, NextEra Energies, NextEra Energy, those are the two there. You look at other sourcing methods. I mean, everybody's been talking about nuclear. Everybody's been talking about natural gas. Geothermal heating is and geothermal electricity generation is still something that going under the radar right now. I would not be surprised if you see that as a major theme. The solar space, there's still solar companies catching a significant bid because it's the quickest way for you to bring capacity online. And then you have the storage, those battery storage names. Now, some of them have been a little bit more outsized, so more of a diversified approach probably to that trade. But those are the areas where the market's going to have to spend dollars at least to kick this thing off. Maybe not down the road 2 years, 3 years from now, if they get these data centers up and running and this, that, and the other, right? Some of them will follow through. Some of them will fail. I mean, let's be real. This is a cycle. Every cycle we have enthusiasm and then we have some failures, but the AI theme itself is still going to thrive and survive throughout. This is going to be revolutionary. But I think next year is where you actually see those dollars being put to work. And I think that's where the opportunities are going to be, because a lot of these industries are really not reflecting the AI spend yet within their earnings announcements. Right now, it's just semiconductors and Caterpillar that just announced the first kind of like look through or read through when it comes to the industrial space and artificial intelligence. And then maybe GE Vernova because they have the gas turbines, right? But there's still a lot of industries that still have not really shown the spend or the amount of spend that's been committed to artificial intelligence. What do you think?
Yeah, I mean, if you also look at uranium, everybody keeps going, oh, well, these nuclear facilities will just be online and everything will be fine. And it's like, how long does it take to actually start a nuclear facility? It could be up to 10 years. It takes a long time to get through the regulations and all the red tape to do it. So we're kind of in a scenario here where we really either we're going to see more government intervention into these sectors, or we're going to start to see these companies actually become extremely interested because it's needed right now, right? Like we're in a scenario here where it's like, it's not maybe we need this much energy. It's we definitely need it. We definitely need to keep working on this infrastructure. So, oops, sorry. So here we got silver. So silver's here hitting new highs again. Man, this thing is just a freight train lately. Like precious metals have been just wild this year. So what are you seeing here, Kevin? We got this cup and handle pattern. We have the long-term cup and handle pattern in silver. If you go back to, what was it, 1980, the other top was in 2011, and the recent top where we broke out finally this year. So silver's just been a monster, and now we have this short-term cup and handle pattern breaking out once again. So what are you thinking about silver here, Kevin? Oh, look at the RSI. RSI is making a new high. MACD is crossing over. Looks good. What are you thinking here?
Yeah, it's setting up. Look, I mean, if you're a technician, this is actually kind of the perfect pattern, right? We had the cup and handle that developed here. You had that handle developing pretty much a week ago, 2 weeks ago or so, and now you are starting to see that breakout to the upside. Also coming back, retesting that 50-day moving average. Look, I mean, if you kind of look over the last couple of months, the 50-day has been a key area of support for this market. MACD turning up, RSI now breaking that structure of making lower highs. Now we are starting to see that being broken to the upside. The technical nature of this says that it's bullish. Now, why is it moving? And I think that's the big question mark that maybe some traders have, others don't care. But why is this actually moving? What we've actually seen over the last week and a half, 2 weeks, is China, which actually has a significant amount of silver inventory, if you will, finished processed silver. You're actually seeing a really big uptick in their export of silver going into Europe. Now, this is probably the coverage for the LME, London Metals Exchange. And if you were looking at China's inventory levels right now, they're at very low levels overall. If this sounds familiar, Jason, it's because it is. What happened with copper early on this year? You and I have been kind of harping on this. China just didn't have the inventory. right? They went through their inventory. There's also a smelting operation issue that they have in China, right, where they're not really making any margins or making any profitability. But you are seeing the physical movement of silver going from China to Europe. That's what's pushing this price higher. And I think the question right now is how long is that really going to last? Now, you and Kashap talked on Friday because I watch you guys' show every week. Kashap is also right. If you're looking at it, it's an industrial metal as well as I think he called it a monetary metal, if I'm not mistaken. But it's an industrial metal and a precious metal, more industrial than precious. It actually costs a lot more money to process silver ore than it does to process gold, which is kind of interesting because there's always been a little bit of a price disconnect compared to
Yeah.
the input costs going into it. But you are seeing obviously demand ramping up higher here. And you name it, from electronics to solar panels to you name it. Silver is still in a structural deficit, and that structural deficit includes not only physical demand but also when you're looking at ETF holdings. That's really what puts that structural deficit over the top. Those individuals buying the SLV, you name it, those ETFs that actually cover on physical or cover on futures contracts and things of that nature, is still in a structural shortage. If you're looking at silver as a barometer of global growth, I think this is actually a positive sign, though. And I mean, at the end of the day, silver's outperformance really does align with one, inflation remaining sticky or even re-rating higher, which kind of makes sense. And 90% of 90% of electronics has silver in it in one way, shape, or form, right? So if that demand kind of goes up, those prices probably remain a little bit elevated. That could push us a little bit higher. Then you also have the industrial need for these AI center build outs, things of that nature. So silver's looking pretty decent right now. We talked about it, I think, about a month ago or a month and a half ago, maybe 2 months ago. If you're a silver trader and this is your first rodeo in the silver, in a cycle of silver, look, you're going to have days where you're going to be feeling like a champ. And then you're going to have days where you're going to be like, what the heck is going on? Why did silver pull back 7% in a day? That's just how silver is. It's a high beta metal. You got to be careful with it. But right now, you are seeing net new longs getting into this product. You are seeing that physical demand that is there. And then you have that breakout. And that breakout extension, really, if you're kind of looking at it, we actually might be getting a little bit close. If you go high to low from that cup and handle, what was this, sitting at around 46, 47. Let's say the brim of this is what, 54. So you got, let's call it a $9, to be conservative, $9 move to the upside plus the extension or that breakout from 53. You're looking at around $61, $62 on that extension before that cup and handle setup gets played out. Let's say that, right? Until that's fully completed. So you got another, what, $4 to the upside or so until you might see another significant area of resistance.
Yeah, I think the precious metal space is just so interesting right now because it's just the right environment. Like there's so many things. Like, yes, there's all this buying. There's all of these fundamental reasons to be bullish on it. Not to mention the ETF holdings. Not to mention the mispositioning. Not to mention people keep shorting the miners, which is wild. There's a lot of reasons to be bullish on this space. But at the end of the day, it's like this trend is unstoppable. And the biggest thing I would say to people is, like, there's a lot of people who keep hitting me up to like, hey, when would you short silver? It's like, not when it's looking like this. Like, when it starts to actually trend down the other direction and starts to really have if it gave a real good false breakdown signal, or it couldn't really sustain these levels, that would be a reason to do it. For me, let's really, like, we start to make 100-day lows. We start to change this trend. The trend hasn't changed. So I just want to stay long silver. I think the whole space looks great. I think the miners look great. I think silver looks great. I think you just want to continue to stay long. I know it looks scary up here, but I think short-term traders looking at what Kevin's looking at, hey, take that trade to 60, 61, take some off the table. Long-term traders like me, if you're riding that trend, just continue to ride the trend. That's it. So, Wavy's asking about. Go ahead, Kevin.
Oh yeah. What's remarkable, silver's up like 95% year to date, which is crazy.
So
That's one
wild.
thing. If you are a physical buyer of silver, and I'm not going to go down our little prep route, like we can dive into that every once in a while, but I went to just explore, because this is how I am. I went to go explore some physical silver yesterday at a particular location, and I had 3 dealers that were there, and I was just getting prices. I was like, "Oh, what you guys? What's the prices here?" Be careful if you're buying silver physical right now. Know your spot rates, and so you don't get ripped off. Honestly, had somebody tell me yesterday they're trading or they're selling their silver, and it depends on the grades, right? But at the end of the day, like if you give me 0.99, I could care less what it looks like. Silver's silver at the end of the day. I don't need a nice imprint. I don't need a nice emboss. I don't need any of that stuff. And they were selling their silver at what, $3? It was $2.50, $3 over spot. Which I was like, oh, okay, like that's kind of still kind of expensive, but whatever. That's actually better than what it was when it was trading at $15, when you were paying pretty much 15, 20% over spot prices. But then I asked the guy, well, what's spot at right now? Just because I wanted to see. You know what he quoted me as spot?
70.
67.50.
Yep. I heard somebody that got a 72.
Yeah, so be careful with that because that's not spot rates. So they're basically trying to, they're trying to get you. So if you're going to buy some physical right now, this is the type of time when you have a week like we had last week. This is the time for you to know your stuff because they're going to be out there. I mean, everybody and their mother is looking for silver, looking for gold, what have you. And there's a lot of good people that are out there, and there's also a lot of people that'll try to rip you off because at the end of the day, that quote that they gave me, they're basically having me pay $12 over spot.
Yep.
Right, which is not how that should work. So
No.
I'm sorry. Yeah, what wave yet?
So wait, I was just kind of laughing because I remember I skipped one on accident and I saw natural gas, and Wavy also asked, she said, whenever you get to it, your thoughts on natural gas and perhaps a natural gas stock recommendation. I don't know, Kevin's, I don't know if you do have a stock recommendation. Sometimes Kevin will be like, I really just think you should own natural gas. Sometimes Kevin does have some names that he likes. So what are you thinking of natural gas here, Kevin? You brought this great chart. Natural gas looks really good. We're getting some closing on a weekly. We're getting some closing highs at new weekly closing highs. We're trying to break above this level that it touched earlier this year, which is around almost $5, $4.93. So what are you seeing here, Kevin?
Yeah, and I never bring in like stocks that I like. I bring stocks that are related to the primary trend that may have a technical setup that kind of correlates with that primary trend, right? So I don't provide any type of recommendations or anything of that nature. Um, you're gonna hate me for saying this. Okay, so can natural gas move higher? Obviously, it can, right? Especially if you start getting retail in it. It could happen. I think that natural gas right now, if you're just looking at it from a technical standpoint as well as from a fundamental standpoint, it's grossly overvalued. But I get why it's doing the moves that it is right now. 2 months ago, 3 months ago, I always say go back, look at the videos. When we talk about that September, October, well, with basically the October, November, December setup on the seasonal basis, we talk about that every year.
Yeah.
Obviously, it's coming to fruition right now. So you have that type of situation taking place. Inventory builds are still a little bit higher. I mean, like it's not like we're seeing this massive draw when it comes to natural gas. People can make a case for the demand side. For me personally, I want to see a longer trend when it comes to demand, and not just throw all eggs in one basket and say, "Hey, this is data center. This has got to rip higher." If, in fact, if you actually look at it, what actually makes a little bit more sense for prices moving higher is probably the expansion of LNG facilities that are going to be brought online over the next year or 2 years or so. I believe we have 6 that are in approval that could come online by next year, if not early 2027. And that's where that bullish narrative kind of gets into place because right now we're doing what, 3.5 BCF, maybe 4 BCF when it comes to the exports there. The capacity is supposed to ramp up to like 30 BCF of capacity a day of capacity for LNG or liquefied natural gas by the end of 2026, I believe, or early 2027. That allows us to take this natural gas that we have, export it out, and then obviously reducing flares and things of that nature. That's probably a little bit more of a bullish catalyst for me than probably on the data center front, at least for now, because there's still some constraints that are there. So me personally, I mean, the chart setup looks good. I ain't gonna lie about that, right? The weekly chart still kind of points to bullish, but if I'm looking at the fundamentals right now, I probably am a little bit more bearish on natural gas than bullish. We did get a weather report that the first 2 weeks of December is going to be obviously very cold, especially when you're looking at the upper Midwest as well as the Northeast. So, demand should be relatively high. And then if you're kind of looking at European inventory levels, last time I checked, I believe they're at like 76%, 73% or something of that nature when it comes to natural gas inventories, which is actually really low compared to what they probably need to stock up for. I think they're also probably basing the fact that maybe we do see this Russia-Ukraine situation kind of dampen down here. I just don't see what's going to take Natty from where we're at right now, at 460 or so, where it gets you back to those levels that we saw 2.5, 3 years ago, where you're starting to talk about seven. This, in my, if I'm looking at it, this looks more like a fade, come back, retest that 200-week moving average at 3.78. But that's just me, and that's just because of the fundamental nature, not the chart. The chart setup says, hey, it's testing to break out. It could have break out hard, it can. But from a fundamental standpoint, there hasn't been anything that's like really kind of justifies a $1.50, $2 move to the upside. That's me. What do you think?
Yeah, I mean, it's once again, it's natural gas. So, like, let's just start there. It's natural gas. What do I think I know about natural gas? I think I know it's very volatile. I think I know it likes to fool everybody. I think I know, the fundamental setup sometimes can tell me a lot. Sometimes it can tell me nothing. Sometimes it's the demand side that really drives the commodities a lot of the time. And I don't know. And right now I'm looking at the same data you are. It doesn't look that great, but I would go future demand could look better. We could run into issues, and maybe that's what the market's seeing right now. And that's the real bull case for this. Now, once again, like if you just look at the data, fundamentally, it doesn't look that great. So I agree with you there. So it's not something that I'm going like, hey, I'm extremely bullish on it or bearish on it. I am long at the moment just because there are long signals, and I will take those always. And so here we are at this level. Basically, right here, right now, it's a make or break point. Like, can we get above that level? Can we continue to trend higher here? That would tell me something. If I'm wrong, and I shouldn't be long, it's basically going to maybe get above that level and crash right back below it. Maybe it stops right here and starts to trend down. So, I think the best thing to do as a trader sometimes is take both cases, which is Kevin has a great case, the price has another great case. And you go, okay, well, how do I trade? For example, myself, I'm trading in a way that I'm looking at the trends, I'm looking for breakouts, I'm looking for all that. So as I'm doing that, I'm going to just take that long. But also I'm going to keep in mind, like, there is a possibility of this thing turning over on its head, just like everything else you're probably going to trade in the world. So just manage your risk properly. That's always going to be the number one case here. But I do like natural gas. I do think there's in this big AI energy trade, I do think that this is a big piece of it. Maybe not the biggest piece of it by any means, but it is another big piece of it. So we'll see where it ends up.
And I can give you, because I want to, let's drill down on this a little bit more, right? Because I don't want you to like, oh man, like super bearish, right?
I don't think you're super bearish. I just think you're looking at the data and it's correct.
Yeah. So it's like, okay, so the LNG export capacity, as that actually does expand or open up or increase, right? What you will see, and what we are seeing right now, is Dutch natural gas prices are like falling off of a cliff, and actually is a significant amount of short positioning, and basically looking at European price, right? As liquefied natural gas expands as far as export capacity here in the United States, we should see a little bit of an uptick for Henry Hub and a downtick for Dutch. That's exactly what's happening, right? We will eventually find some form of an equilibrium. That also could be taking place here right now as well. I want to be mindful of that. If inventory levels, if you're looking at it from the U.S. standpoint, we're still 4% above the 5-year average. So once again, that's a little bit more of a bearish tone. But you are seeing earlier draws than what we've seen from this time last year, right? Which is also bullish, and that's because of weather. Weather trades on a dime, though, right? Or changes on a dime, and so will natural gas. Will change on a dime here. I look at it and say, hey, man, positioning might be a little bit stretched. The AI narrative is definitely going to be there. But even if you look at the AI narrative, dude, and you look at demand levels right now, you're not seeing like this massive uptick. And that's what's going to make it hard about this whole AI trade. And we can go to the next thing after, but that's what's going to make it very hard, because there's so many different ways to produce electricity, and then also it's where the need is going to be. It's not like it's an immediate draw on everything on the grid. That's not how it works, you know. So it's like the demand levels for natty, is it moving a little bit higher on the commercial front? It is, but like it's not like this massive reacceleration. But if you kind of look at the Northeast itself and you look at some of these pockets of the market where retail natural gas prices or electricity prices have darn near doubled, if not tripled, in some pockets of the market, you are seeing the demand side there, right? But you're not seeing it on a national scale. So you got to be really, pick and choose. Not a recommendation, but the natural gas equity names that are out there, like the EQTs of the world. Actually, Duke's another one that's actually a natural gas utility play. So Duke Energy, they actually just expanded some of their um, infrastructure on the East Coast to basically provide power to a pretty decent sized data center that's out there. So they are seeing the effects. EQT is another one that people look at. We talked about liquefied natural gas. Now you are seeing prices for LNG move lower, and that should actually happen, right? As we get more capacity, prices will move lower. There's certain areas in the market where they are experiencing gluts, and demand starting to wane a bit, especially if you're looking at the Asia market. So names like a Cheniere Energy kind of falling back here a tad bit. You can make the case that 190-ish could be an area of significant support. Right now on the weekly chart, could pull back here a tad bit. On the daily, looks a little bit oversold. And then I look at Venture Global. Once again, not a recommendation. If you look at Venture Global right now, coming back, retesting that $7-ish area, which has been an area of support for this name back in April of this year. They have a significant amount of, they're one of the biggest LNG exporters in the United States. They are bringing on capacity. They do have some legal issues, though. They have some disputes right now with some really big energy companies that are out there because of lack of delivery and all this other stuff, right? But that's another one that's like that I'm keeping my eye out on, Venture Global, because if you look at their assets that they have on their books, last time that I checked, their assets are actually greater in notational value than Oxy Petroleum, but it's trading at a significant discount on a relative basis compared to Oxy. So there is a fundamental disconnect with Venture Global. Those are the three names that I usually just look at, though, but there's no recommendations come from there. So, Jason, I'll kick it back over to you.
So Freely had a question. Do you use a trailing stop with natural gas or a hard stop? So for me, the way I trade natural gas is the way I trade everything, which is trailing stop. However, and why I want to answer this question is because there's a significant thing when you think of trailing stops, which is most people, when they're thinking of trailing stops, get into the, hey, I need to make it tight. I need to make sure like I catch all these profits, all of these things. Sounds great. But in reality, like you're just going to get stopped out a million times, and basically you get the death by 1,000 cuts, meaning, basically like you're going to take all these tiny losses, tiny losses, tiny losses. And so if you back test this, and this is the way to really learn this so it really sticks in your head, and then you can do this for yourself properly, which is you back test it and you go, okay, I'm going to buy, let's say 100-day breakouts on natural gas. How does that system work? Okay, let's say the system's profitable. Let's say it makes some good trades. It's right about 40-50% of the time. Okay, now I put a really tight trailing stop on it. Let's say it's a 4% trailing stop on natural gas. What does that system turn into? Well, I actually lose money on that system. 40-50% is actually really good because the winners are going to be a lot bigger than the losers. But now the winners are small, the losers are small. And most of the time, the system ends up losing a ton of money over time because your stop's too tight. Now, if you take that same system and you go, okay, instead of a 4% trailing stop, I'm going to give this thing room to run. I'm going to test the volatility. Okay, I really want to hang on to these big long-term trends. How wide does my stop need to be? You're going to run around 24 to 28% trailing stops on natural gas, which doesn't mean like, hey, like people think about that and they're like, okay, if I have my whole portfolio in natural gas, I'm going to lose 28%. That's insane. You should never have your whole portfolio in a trade. It should be, if you have $100,000, just to make it an easy number, you should look at something like I'm going to have $5,000 at the most in something like natural gas, or $4,000 even. And then you have your 28% trailing stop, let's say. And so you're only going to lose a little bit on that. But this is going to give you that room to run. That doesn't mean you can't use targets. It doesn't mean you can't use exit signals. Just stop losses should always be that catastrophic, holy shit, this is all going against me. I got hit very quickly and I'm out. It doesn't need to be this. It's a risk management tool more than a specific trading setup tool. So always use very wide trailing stops. Natural gas, I'm running around 24 to 28% most of the time. Things like Bitcoin, I'm running around 30. You got to have very wide trailing stops to trade these things.
Yeah, and if you are just getting into it, look, ease into it. Look at UNG or maybe some of these ETFs first if you want to get exposure. Maybe then look at the micros contracts. And then if you have the capital to do so, then maybe you edge over to the big contracts. Personally, like the micros are good enough, the depth's pretty decent, or you can look at natural gas options where you still are risk defined if you're going with a call spread or a put spread, which is usually the ways that you want to really trade those things. But just to put some context here, 5%, 6% move in Natty isn't anything. I mean, we had a 6% move on Friday. We had 30 and let's say 30 and a half cents. That's a $3,040 move just for one big contract. So even if you look at the micro and you size that down, it's $340 just on a 1-day move, right? So natural gas is one of the most volatile products that are out there. It can move very aggressively, and it could be something that you love, or it could be something that you hate. But you also have to understand that sizing is going to be key. Like, could you afford to, let's say you were short Natty, could you afford to take a $3,000 hit in 1 day on the contract? Just one big, right? Most retail traders cannot. And so you look for other proxies in order for you to get like exposure. That's basically what I'm trying to say. So the micros, they're good, but you will need to have some better stops. Like if you're trading a micro contract, and just in my opinion, it's better to have just an outright stop than a trailing stop, because sometimes those micros, they're a lot more thin than what you're looking for Natty, like the big contract, right? And so sometimes your trailing stop could be like triggered. I don't want to say for no reason, but you get like I don't want to say a glitch, but you get a blowout quote because there's nobody backstopping it, and then boom, your trigger gets hit. When you look at commodities, commodities generally don't have designated market makers from the exchanges like equities do, where the exchanges, they have to keep a book size, right? So basically the spreads have to be at a certain diameter, they have to have a certain amount on the top of book, right? 10 shares, 100 shares, what have you. Commodities, they don't require any of that. Right. And so that's where once you trade a thinner market, or maybe a product that's just starting to get a little bit of traction like the micros, probably doing an outright stop at first, it serves you a little bit better than the trailer. But you also lose on that too. Let's see that thing like moves aggressively overnight, which Natty can do that, right? There's nothing to wake up, and natural gas moves 4%, 5% by the time you wake up, right? You could lose out on that alpha. It just depends on how you kind of trade. If you trade in the bigs, probably not worried too much about the trailing stop being triggered because of some outsized quote. But micros, it can happen. It has happened to me several times doing the trailer. So
no, good point. And so Cheniere Energy, looking at that one, coming back to the support zone. What are you seeing here?
Yeah, kind of like I just talked about, right? I mean, this is one of the bigger plays for the liquefied natural gas trend. As more capacity gets put online, the companies like Venture or Cheniere theoretically will lose a little bit of market share. So you are seeing this hinge a little bit lower. That $200 level on a daily, though, has been an area where buyers kind of step in. But the trend right now is kind of signals that maybe it wants to go down to 193. The options on these could be fairly expensive, but the stock actually can move. And it's like it's one of those under the radar, not a lot of people trade it type of stocks. Spreads on the options can be a little bit wide, but this thing can move very aggressively, as we have seen in the past. So sometimes the options on those, if you do the monthlies that have probably the most liquidity out of all of the series, the options could be pretty decent swingers here, but The chart doesn't look that great, but we did get a decent bounce. If you look at the daily chart, we actually did have a couple of days where buyers did step in over the last couple of trading sessions, 2 hammer candles in a row, a little bit of a doji type of candle that took place, a little bit of a follow through candle, but it is kind of hitting up to an area of resistance on when you look at that let's say once you get to around that 215-ish area, that has been a fade area for this thing.
So getting into crude oil. So let's talk about oil. Oil's been just terrible. Just a frustrating, terrible trade all year long. And I'm not saying even like long or short, like it's long, like you're getting stopped out basically every step of the way. Short, it's very choppy, a little bit more downside lately than upside. Just all year long, it's just been very choppy. So, are we thinking that energy is ever going to move anywhere? Especially crude oil, because we're looking at the energy sector. We're seeing the refiners, we're seeing the shippers, we're seeing crack spreads widen. We're seeing a lot of things happening in that area. That's interesting, but oil just hasn't been able to find its footing yet. So, what are you seeing here on this chart, Kevin?
Yeah. So if you're looking at oil, the buy area for the most part has been around that $57-ish area where buyers have been stepping in. We haven't broken that yet. And if we do kind of break this level, then you start talking about maybe that $45-ish area. I think once it gets down to, if it does, get down to around 45 or $40-ish. I don't know. I think you'll probably see some institutions try to step in there. To catch that dip here. RSI doesn't look that great. MACD doesn't look that great. Now, one thing to just note, crack spreads actually have been breaking lower over the last 4 trading sessions. It's still at elevated levels, right? Crack spread, 3-1 crack spread, still sitting at around $24.80. So that's still good. What does that really mean? That oil hasn't been looking that great, but the byproducts themselves have been outperforming oil on a relative basis. So on a relative basis, if byproducts are outperforming, oil is moving a little bit lower, those crack spreads expand. That's better margins or profitability for those refiners, which obviously they've been doing a pretty decent job. Just when you look at the refiners, if you start seeing that crack spread really starting to deteriorate over the next 2 weeks, 3 weeks or so, those refiners could see a little bit of a pullback. You are seeing some buyers stepping into energy equities. I don't know if it's really the integrateds that really catch the eye of a lot of traders. I think right now it's the servicing names. If you kind of look at those, the BKRs of the world still looking pretty strong. Halliburton, once again, had pretty decent earnings. Those look relatively decent. So you look at the XOP, Spider S&P Oil and Gas ETF, on the weekly basis, it's hitting that 200-week moving average to the upside, but it's really pinched between the 200-week and the 20-week. I'm looking at this one to really develop. If it does actually break out here, you could actually look at a pretty decent move to the upside here. The oil market demand side, not really that great. Nothing that really kind of like scoff at. Gasoline demand is doing okay, but it's nothing that's outsized, screaming that demand is just going through the roof. And in fact, what's actually very interesting is our utilization rates when it comes to capacity within these refiners. They're actually at pretty elevated levels, given the fact that we just had maintenance season. We're kind of getting out of that. And I think we're still sitting at around like a 92, 93% operating rate for these refiners, which like going into the wintertime is actually pretty high. So that's once again kind of bringing that supply into the market. You can see the gasoline supply numbers that we had from the EIA as well as the API earlier this week. Distillates kind of moving to the upside. Now, if you're looking at the inventory levels for, let's say, distillates or even gasoline, I believe gasoline is still below the 5-year average. So like anything that's a massive uptick or any type of stimulus coming out from either the federal government or monetary policy completely shifts and becomes very dovish, that could actually rip those gasoline prices higher, which once again, if they outperform crude, then preserves those crack spreads here. But the contract right now is still making lower highs as well as trying to keep this low that we're at right now. And we'll see how this actually pans out. I mean, there is, there's this battle about floating storage that's out there right now. I think there is some warrant to that. But we did actually have this pipeline, this Caspian pipeline that got hit by Ukraine, I believe it's like a day ago,
Yeah.
maybe 2 days ago. I think they actually just formally announced that like 2 out of the 3 wars with them that operation is down because of substantial damage. So that'll take off some product offline on the global stage. I believe that pipeline commands around 1% of total global supply, if I'm not mistaken, at these current levels before the strike. So that probably actually could be a little bit of a bump to the upside. You have some geopolitical risk with Venezuela. That could be a little bit of a bump to the upside. You had, I believe, Iran fired some ballistic missiles into some Iraqi airspace. I don't believe that they were near oil infrastructure, but like if that does escalate, that could be a tailwind for it. But and then you also have a lot of bears within this as well. And so when you kind of look at the setup, what you'd like to see is it basing out. Maybe you get a strong demand catalyst, not supply, but a demand catalyst that's out there. You get a short covering rally, and that's where you get a little bit more bulled up. But right now, I think you continue to look at that 57 as that bounce area, scalp, comes back, test 57, 57 and a half, scalp once again. And if we see any type of major break below that 57 or even say $55, then that's probably a bigger short on the technical standpoint for crude oil.
Nice. Okay. Good points there. So we only have about 10 minutes left. So getting through live cattle. Jerry was asking about corn too. I don't know if you brought a corn chart today. Did you bring a corn chart?
I did not, but if you want to bring
Let's
up
talk
a corn
about cattle
chart,
and corn. Yeah.
Yeah. If you have,
I can bring up one. Let's
chart,
talk. Let's talk about corn a little bit.
Okay. All right, so what you are seeing for corn exports, actually over the last 3 weeks, 4 weeks or so, they're actually going above or coming in above the average that the street has, or the whisper number when it comes to the street. So you are seeing some buyers actually, stepping in. I think this is a short covering rally that's taking place first. The export numbers are starting to look good, especially now that we have the USDA export sales coming out every week. So those look good as well. You also have two other scenarios taking place within corn. There's a potential drought that's being forecasted. It's actually happening right now in Brazil. That is potentially going to have an impact on some of their corn exports. You are seeing some of those agencies within South America kind of re-rating their production levels or their harvest levels a little bit lower than the market expected. Actually, a lot lower than what you're looking at for the USDA estimates that just came out from WASD about a week ago or so. And you have a dope bottom, and you have some buyers kind of stepping in here. So, do you get really optimistic? I mean, there's still a lot of inventory left. Year-ending stocks is still going to be elevated. But you are seeing some strong demand when you're looking at the ethanol processing right now too, which is obviously once again another kind of decent catalyst when it comes to corn in itself. So some buyers are stepping in. The export numbers actually are better than, on a relative basis, better than what we're looking at for soybeans, and technically soybeans has that that China backstop. So yeah, corn's moving pretty decent. You would look at really around that let's say 465 and a half is your next major area of resistance, and that's if you're kind of looking at that March contract for corn. So it's making a move. I think it's a combination of different factors though. And those export sales actually have been doing pretty well. Once again, I think it's over the last month and a half, 2 months or so, corn's just starting to catch a bid or starting to respect that trend. And if that continues to the upside, I think you could actually see maybe a little bit of buying activity on the corn front. And this is also a weather trade too. Once again, South American weather. There's a little bit of a concern about the Midwest this year, Midwest right now here in the United States. But honestly, I wouldn't put too much weight on it. A lot of the harvesting has taken place. I think there's only like 8% that's still left to go. So will they have a problem if you start seeing snow, like we saw some snow in Indiana, I believe yesterday, or Michigan or wherever? I mean, could that be a problem? Yeah, but I don't think it's going to have a massive impact on U.S. production. I think everybody's focusing on South America and the export sales.
No, I love it because it's something that, one, we've been covering the corn and soybean and wheat market for a while. We've been talking about that it had this great setup a couple years ago all the way, but we just never got the price action we wanted. Now we're finally seeing the price action finally start to step up. Corn's making 100-day highs, soybeans making 52-week highs. And now it's just continuing to kind of trend. It's chopping around recently, but it's kind of trending. So, the setup is starting to be there for the grains, and I'm excited to see it. And also, you were talking about live cattle. So let's talk about cattle and how that affects the corn prices, Kevin, because that's something we're also seeing. We're seeing cattle kind of move the other direction, and that's affecting the corn prices a bit as well.
Yeah, a little bit, yeah. So, and I want to be very concise with this as well. The live cattle futures market, even the cash market right now, is a hot mess. I think that's the technical term for it. It's a hot mess because of the policies that are coming out of the White House right now. One, like the at first kind of targeting the cattle ranchers here in the United States because of beef prices, which they don't really have any power in that in some respects. A lot of the constraints that we've seen for U.S. production or U.S. Growth in herds for cattle is something that's a lot of it's out of their control. Right, it's a higher input cost when it comes to feed, yeah, but it's like lack of water, uh, and then they don't really have any type of leverage when it comes to the processors because there's only like four major processors here in the United States, and it's a very tight market. You could call it a little bit of a monopoly. Technically speaking, it's still holding the primary trend if you're looking at the 3-year weekly chart. So I have that up. It's still holding that. Actually, it doesn't really break that until cattle hits to around 200 cents. Um, but this doesn't look really that great. You have a lot of longs that have completely just dumped and even turned into shorts. From a fundamental standpoint, it looks like we might be making a deal. I believe we actually did ink this deal. We're going to be making a deal with Argentina to bring in beef, right? So not actual cattle, but beef, bringing those into the processing plants in order to try to increase beef supply here in the United States. And then there's also a concern that in Mexico, we're going to open up our this is going to be kind of funny. You guys will know I'm not going to harp on it, but we're going to open up our borders to Mexico in order to bring in live cattle from Mexico. There is a potential for that. It has not been officially announced, but the Ag Secretary has been hinting towards this over the last 2 weeks, 3 weeks or so, which is also pushing prices lower, right? Increasing that supply of cattle here in the United States. Once again, kind of pushing prices a little bit lower. There is a risk on the Mexico front, because they do have, screwworm issues that could infect a whole herd, which has been a problem in the past, which is why we put those, that's why we stopped importing the live cattle. There's talks that has been kind of eradicated in some respects. I think if you talk to actual ranchers out there, they're calling BS on that fact. But just the increase in supply of beef, the increase in supply in cattle is pushing these prices a little bit lower. And right now, this seems like it still has a little bit more pressure. A counter trend bounce to the upside could be intact here, but it seems like the fundamentals are swiftly changing because of policy in order to bring those prices down. Obviously, there was an election too. That was one of the big issues, affordability. If you can go to that next chart, though, this is also going to talk about, not next, yeah, next chart, that JBS chart. Did I add that in there?
Yep.
Okay. All right, so let me go to the processors here. There's only four major processors here in the United States that process over 75%, 80% of the overall beef here in the United States. Two of them are private, and then two of them are publicly traded. One is Tyson Foods, one is JBS. So we've been kind of talking about the live cattle side for a very long time. JBS processes, I believe, actually 70% of all beef here in the United States. That goes here in the United States. Look at this stock. So this one just recently IPO'd, I believe like a year ago or so. Obviously, you saw that ramp up after the IPO. It's moved to the downside here. I mean, this is a stock that's only trading at like $14 or something, but you are starting to see it actually move aggressively higher. And in fact, off of those lows at 1237 to where it's trading at right now, it's up around 20%. Tyson Foods over last week actually announced that they're going to be closing some of their beef processing plants, right? So Tyson has exposure to beef, pork, and chicken, poultry, right? Beef been a challenging market, and they can make a little bit more money on the pork as well as the poultry side. And so it seems like they're going to be actually reducing some of the processing capabilities, which should actually push some of those flows over to JBS in order now. There is actually obviously a lot of controversy around JBS, and they're cornering the market, what have you, this, that, and the other. At the end of the day, it trades. It's getting positive flows right now. Could it take over some of that Tyson Foods processing? It could, probably will. when you're looking at that capacity here. And this is a stock just to keep on your radar for 2026. Not a recommendation, but this is a stock that's very low key, but you're starting to hear a lot of chatter where the news flow can actually impact this one pretty significantly to the upside. Now, what happened with the processors is over the last 15 years or so, the processors ramped up aggressively their capacity. But what also happened at the same time, right? Herd sizes went lower, smaller and smaller and smaller. So they have excess capacity from the processing standpoint. They don't have enough to be able to backfill that capacity. So you have this situation where the processors are charging exorbitant amount of rates to process beef in order to offset some of the spend that they've had over the last 10 years or 15 years or so. And none of that's really being trickled down into the cattle ranchers themselves. So interesting dynamic within that market, but one that's underloved, and I think probably will get a lot more focus as well. And then if we do see herd sizes increase, we get the imports from of live cattle from Mexico. That could also increase feed demand, which could also push prices of soybean meal higher. Could also push prices of corn higher as well. So there could be some residual impacts on the grain market if we do see these policies put into effect here.
No, perfect. So we're gonna end there. That's fucking great day today. I'm like so excited to go through these markets. I was just thinking about it as you were talking. I'm like, there's very few people that I can like go through like all these commodity markets with and all the macro stuff and even stocks and technology with that I can talk to. And it's basically like you. And I was like, so this was exciting to just start with the S&P 500, technology, overweighting, value, and so on, all the way to live cattle and corn. Thank you guys so much for joining us today. We will be trying to do these pop-up lives as much as we can. So we'll probably do them, Sundays. I like Sunday mornings. Sunday mornings is fun. I feel like a lot of people end up showing up and hanging out. So Sunday mornings are good. If you guys like Sundays, definitely let us know. We'll try to do these more often. And you guys have a good one, and we'll see you soon.